Every major financial collapse of the last century shared something most people never saw coming. Not a coincidence, not bad luck, a sequence. It begins quietly, long before panic headlines, long before portfolios bleed red. By the time the public realizes something is wrong, it's already over. In 1929, one man warned Wall Street that the system was fragile. They laughed at him. They called him paranoid. They trusted the experts who promised stability. Weeks later, the market erased a generation of wealth. And what history shows us is unsettling, because it wasn't chaos that caused the collapse. It was structure, predictable, repeatable. The same buildup appeared before the dot-com implosion, before the global financial crisis. And now, it's forming again. Debt expands faster than reality. Risk concentrates where no one is looking. Those with inside access quietly step aside. Liquidity vanishes invisibly. Everything looks fine until it isn't. Today, we are no longer at the beginning of this cycle. We are deep inside it. And the most dangerous part isn't the crash itself. It's believing that this time is different. Because history doesn't repeat loudly. It repeats patiently. History doesn't repeat itself loudly. It whispers. And almost no one listens. For over a century, every major financial collapse has followed a precise sequence of events. Not a vague resemblance, not a loose similarity. The same structural progression unfolding quietly months, sometimes years, before the damage becomes visible. This isn't conspiracy, it's pattern recognition. In 1929, the warning signs were already present long before the headlines screamed panic. Credit was expanding faster than productivity. Asset prices were rising faster than wages. And a small group of insiders had begun repositioning, silently. Economist Hyman Minsky, decades later, would formalize this behavior into what we now call the financial instability hypothesis. His conclusion was unsettling. Stability itself breeds instability. The longer markets go without disruption, the more risk they absorb, slowly, invisibly, until the system becomes fragile enough that even a minor shock can break it. This same progression appeared before the 1987 crash, before the dot-com collapse, and before the 2008 financial crisis. Different assets, different narratives, identical structure. First, confidence rises, then leverage expands, then risk concentrates, then liquidity thins. The final stage always feels impossible until it happens. Researchers at the Bank for International Settlements have repeatedly shown that when total debt exceeds long-term economic output by a critical margin, the probability of systemic failure rises sharply, not gradually, exponentially. In the late 1920s, total U.S. debt reached roughly 260% of GDP. In 2008, it crossed 300%. Today, it sits even higher. But here's the most dangerous part. The cycle doesn't announce itself when it begins. It hides behind optimism. Headlines celebrate innovation. Analysts raise price targets. Policymakers reassure the public. Everything feels normal. That's why these moments are so powerful and so deadly. By the time the average investor realizes a cycle exists, the cycle is nearly complete. History shows this again and again. Those who recognized the pattern early survived. Those who trusted appearances did not. And right now, according to long-term market data, stress indicators, and institutional behavior models, we are no longer at the beginning of this sequence. We are somewhere in the middle, the same middle that appeared before 1929, before 2000, before 2008. The question isn't whether this cycle exists. The question is how far it's already progressed. Because once the pattern reaches its final phase, it doesn't slow down, it accelerates. And what comes next is never announced in advance. It simply arrives. Crashes don't begin with panic. They begin with borrowing. Long before markets fall, something far more dangerous happens quietly in the background. Debt starts growing faster than reality itself, faster than income, faster than productivity, faster than the economy can support. At first, it feels harmless, even healthy. Economist Irving Fisher described this nearly a century ago with his theory of debt deflation cycles. His warning was simple but brutal. When debt expands beyond the system's ability to service it, collapse becomes a matter of timing, not probability. History proves him right. In the late 1920s, ordinary Americans were buying stocks with just 10% down, borrowing the remaining 90% on margin. By 1929, margin debt had grown so large it equaled the entire U.S. federal budget. Factory workers were leveraged like modern hedge funds. Nobody thought it was dangerous. Prices were rising. Everyone felt richer. That's the illusion debt creates. In the late 1990s, the same pattern appeared again. Companies with no profits borrowed billions to scale growth. Stock prices became collateral. When valuations cracked, the debt structure collapsed with them. Then came 2008. This time, it wasn't stocks. It was homes. Banks engineered mortgages requiring no income verification, no down payments, and adjustable rates that exploded years later. These loans were packaged, sliced, rated as safe, and sold worldwide. Debt was hidden, but it was everywhere. When homeowners couldn't pay, The entire system froze. Now, look at today. Official margin debt sits near $750 billion, but that number is incomplete. Wealthy investors borrow against portfolios through securities-based lending. Options markets allow tiny amounts of capital to control massive positions. Corporate debt has surged past $10 trillion, much of it used not to build businesses, but to buy back stock. Then there's government debt. Over $34 trillion are growing so fast that interest payments alone rival national defense spending. As a percentage of GDP, total U.S. debt is now higher than it was in 1929 and 2008. This matters because debt doesn't just amplify gains, it amplifies fragility. According to studies from the International Monetary Fund, once debt reaches extreme levels, small disruptions cause outsized damage. A 1% rise in rates can trigger cascading defaults. Liquidity evaporates. Forced selling begins. And here's the key danger. Debt growth feels like prosperity until it suddenly feels like suffocation. We are no longer debating whether debt is high. We are measuring how sensitive the system has become, because once debt ignites the cycle, every other stage accelerates. Concentration, insider exits, liquidity breakdown. Debt is always the spark. And history shows that when this spark burns long enough, the explosion becomes unavoidable.
Markets don't collapse because prices are high. They collapse because risk stops being shared. At the surface, everything looks diversified. Hundreds of stocks, thousands of funds, endless choices. But beneath that illusion, weight begins to pile on to a very small number of assets. And when that happens, the system becomes brittle. Economist Benoit Mandelbrot, the pioneer of fractal finance, warned that markets are not smooth or evenly distributed. They are clustered. Risk doesn't spread evenly. It condenses. When it does, shocks don't dissipate. They explode. History proves this again and again. In 1929, a handful of glamour stocks dominated the market. The most famous was Radio Corporation of America. RCA didn't pay dividends. Its technology was barely understood, but the stock rose relentlessly from under $2 to over $500 in just a few years. At its peak, RCA carried an outsized share of market value. When it cracked, confidence shattered. The selling didn't stay isolated. It spread everywhere. In 2000, the same thing happened under a different name. .com's The Nasdaq wasn't diversified. It was concentrated in fewer than a dozen companies. Cisco, Intel, Microsoft. When those leaders rolled over, the entire market followed. Over $5 trillion evaporated. In 2008, concentration hit inside the banking system. 5 institutions controlled the majority of derivatives exposure. When Lehman Brothers failed, the shock nearly collapsed the global financial system. Now look at today. The top 7 stocks in the S&P 500 account for over 30% of the entire index. At times, closer to 35%. That means when someone buys a so-called diversified index fund, they're making a massive bet on a handful of companies: Apple, Microsoft, Google, Amazon, Nvidia, Meta, Tesla. If those 7 stocks fall 50%, the broader index drops 15 to 20%, even if every other company stays flat. That's not diversification. That's compression. Passive investing has accelerated this trap. Every dollar flowing into index funds automatically buys more of the largest stocks. Their prices rise. Their index weight increases. The next dollar buys even more. It's a feedback loop. Brilliant on the way up, violent on the way down. According to research from Vanguard and JP Morgan, periods of extreme market concentration have historically preceded sharp drawdowns. Not because the companies failed, but because expectations became impossible to meet. These stocks are priced for perfection. Perfect growth, perfect margins, perfect execution. Any disappointment becomes systemic. And once selling begins, it feeds itself. Index funds don't think. They rebalance. Outflows force selling of the largest positions first. Liquidity thins. Volatility spikes. The trap snaps shut. Markets don't fall evenly. They fall where the weight is. And right now, the weight has never been heavier. The market looks calm, Prices are stable. Headlines reassure the public. Everything is fine. Fundamentals are strong. And yet, beneath that surface, a silent exodus is underway. This is the stage that defines winners and losers. The smart money exit. The moment when those with access to the real information begin to sell quietly, systematically, and strategically. They don't announce it. They don't tweet warnings. They don't publish alerts. In fact, they actively encourage everyone else to stay invested, because the more people left behind, the more profitable the move becomes. History is unforgiving. In 1929, the Morgans and the Rockefellers began liquidating months before the October crash. The same pattern repeated in 2007. Hedge funds started shorting subprime mortgages. A full year before the collapse, Goldman Sachs famously bet against the very securities they sold to clients. Executives at mortgage lenders were quietly selling personal holdings while public statements reassured the market. Retail investors, unaware, continued fueling the bubble. Behavioral economists describe this as asymmetric information exploitation. Those who hold knowledge, connections, access, and analysis act while the uninformed follow the herd. The market's outward calm is a deceptive mask. This stage creates tension because it's psychologically invisible. Average investors see optimism and stability. They trust the public narrative. Meanwhile, those who can read the signals are already exiting. Once a critical mass of insiders moves to cash, the fragility of the system is exposed. The next market tremor, any trigger, will have outsized effects. And because so much liquidity has already been siphoned off by smart money, small shocks can cascade into enormous losses. The lesson is brutal but simple. Calm markets are often the most dangerous. The moment insiders begin leaving quietly is the moment the public still thinks everything is safe. And right now, according to historical ratios of insider activity, we are dangerously close to the same configuration that preceded every major crash in the past century. Everything appears normal. Prices are steady. Trading volumes are healthy. On the surface, the market is breathing. But underneath, liquidity, the lifeblood of financial systems, is quietly draining away. Liquidity is oxygen. Without it, the market suffocates. Trades fail to execute. Prices gap violently. Feedback loops ignite. Panic spreads like wildfire. In 1929, the Federal Reserve began tightening monetary policy to cool speculation. Interest rates rose. Credit contracted. At first, nothing happened. Stocks continued rising. People assumed the system was resilient. Then came October. When selling began, there was nobody to buy. The bids vanished. Stocks didn't just decline, they plunged into a freefall. The market literally ran out of oxygen. Fast forward to 2007-2008. The Fed had been raising rates, tightening credit. Housing prices stayed high. Markets seemed fine. Then Bear Stearns collapsed. Then Lehman Brothers. Suddenly, liquidity disappeared. The system froze. Trillions evaporated within months. Today, the signs are already visible. The Federal Reserve has raised rates from 0 to over 5% in less than 2 years, the fastest pace in 4 decades. Quantitative tightening has withdrawn hundreds of billions from the financial system. Banks are under stress. Lending conditions have tightened. Yet stock markets flirt near all-time highs. Headlines proclaim optimism. Investors feel invincible. But we saw the cracks in March 2023. 3 major banks, Silicon Valley Bank, Signature Bank, First Republic, collapsed in a single week. Not small players, institutions of systemic importance. Their failure was driven by a liquidity crisis caused by rising rates and rapid withdrawals. The Fed had to intervene with emergency lending, effectively printing money to stabilize the system while calling it temporary support. Even the U.S. Treasury market, the most liquid market in the world, has shown intermittent stress. For a market that underpins the entire global financial system, These plumbing problems are not minor anomalies. They are early warning signals. Liquidity is the invisible scaffolding holding up markets. When it fades, the scaffolding collapses silently. Small shocks become massive disruptions. Volatility spikes. Panic spreads faster than anyone can react. Behavioral finance shows that most investors only perceive risk when it becomes visibly catastrophic. By then, it's too late. The system is already in freefall. And here's the chilling part. All four preceding stages, debt, concentration, smart money exits, and tightening liquidity, are already flashing red. Historical patterns indicate that once these indicators align, the trigger for a crash typically appears within 12 to 24 months. The oxygen is leaving the room. Markets still look normal, but appearances are deceptive. After debt has ballooned, risk has concentrated, insiders have quietly exited, and liquidity has drained. All it takes is a single spark. The trigger is not the cause of a crash. It is the final catalyst, the event that exposes the system's fragility and unleashes the domino effect. History shows how minor events can topple empires. In 1929, it was a relatively obscure British finance scandal, the Hatchery case. Clarence Hatch, a financier in London, was arrested for fraud. Few Americans paid attention, yet British banks, entangled in the case, had to liquidate assets in the U.S. Their selling cascaded through the market, igniting the Great Depression. A seemingly insignificant event became catastrophic because the system was already primed to fail. In 2008, it was Lehman Brothers. But it could have been Bear Stearns, AIG, or even a regional bank. Lehman's collapse was the spark, not the fire. Trillions in exposure, opaque derivatives, leveraged bets. The system was ticking like a time bomb. And today, nobody knows the exact trigger. That's the terrifying part. It could be geopolitical, a sudden escalation in Taiwan, an unexpected Middle East crisis, or a miscalculation with Russia. It could be financial, a major hedge fund imploding, a sovereign debt default in Europe or Asia, a derivatives counterparty failure. The derivatives market alone exceeds $600 trillion in notional value. One misstep can cascade globally. It could be institutional, another regional bank failing, a commercial real estate lender collapsing, or a run on a systemically important bank. Or even political, a debt ceiling standoff, a constitutional crisis, or a sudden loss of confidence in the U.S. dollar. And historically, the trigger is almost never what the public fears. It's the unexpected, the hidden, the overlooked. The science of complex systems teaches us that when networks are highly leveraged and interdependent, small shocks produce outsized effects. Researchers at the Santa Fe Institute called this the fragility paradox. When everything appears stable, the system is often closest to collapse. Right now, all four preceding stages, credit expansion, concentration, insider exits, and liquidity drain, are already active. Patterns suggest that the trigger could strike within 12 to 24 months. Potentially between 2025 and 2026. The market may seem calm. Headlines may reassure. Analysts may downplay risks. But the spark is coming, and when it does, the collapse will unfold faster than most imagine. History is clear. Collapses are never caused by a single factor. They are the culmination of systemic fragility, with the trigger acting as the match. The question isn't whether a trigger will arrive. The question is whether you are prepared to recognize the signals before it ignites. The signals are flashing red. Debt is at record highs. Liquidity is draining. And insiders, they're already exiting. You now know the pattern. You've seen the history. You've felt the tension building beneath the calm surface of the market. But knowledge alone isn't enough. Action is what separates the unprepared from the survivors. Subscribe now. Turn on notifications, because over the coming weeks, we'll break down every stage, the data, the warning signs, and the exact numbers you need to track. Don't wait for the headlines to scream panic. Don't wait for the spark to ignite chaos. The difference between thriving and losing everything could be what you do today. Click subscribe, stay alert, stay ahead. Your future self will thank you.